So imagine watching one stock grow to dominate your portfolio, only to see it crash and burn and, taking away your dreams of early retirement with it. Today, me and my AI assistant Tiara are going to teach you the best way to rebalance your stock portfolio, which is a strategy used by approximately 90% of professional money managers. You'll learn how to protect your wealth, maximize your returns, and avoid a situation where your portfolio tanks due to one or even a handful of stocks. Plus, we're going to expose the number one rebalancing mistake that can cost you tens of thousands of dollars in unnecessary taxes if you aren't careful. But before we get into that, Tiara wants you to understand the first step.
First up, assess your current asset allocation. This is fancy talk for what percentage of your money is in what type of investment.
Now, doing this, it may seem intimidating, but it's actually pretty easy to do. So before you try to do anything yourself, take a look at your brokerage account. So for instance, I have mine with Schwab, and you can see here that it breaks all these numbers and categories down automatically for me. But if your brokerage doesn't do this, you can do it manually instead. So what you want to do is you want to list out all of your investments, stocks, bonds, real estate, and cash, anything that's an asset basically, you name it. Group them into broad categories like stocks, bonds, and cash. Calculate what percentage each category makes up of your total portfolio. So let's say you've got $100,000 total. If $60,000 is in stocks, $30,000 in bonds, and 10% in cash, then your asset allocation would be 60 stocks, 30 bonds, and 10 in cash. Now, here's where it gets interesting. So some investments, they'll grow faster than others. And this can be problematic because if they become too large of a part of your portfolio, it can really ruin you financially when they inevitably fall. So after categorizing them, you want to spot the ones that are getting too big and which ones are, falling behind. And to figure this out, you need to know your target allocation. So, let's say that your goal is to get to 50% stocks, 40% bonds, and 10% cash. Well, comparing this to our earlier example, stocks are overweight, right? Because they were 60% actual versus the 50% target. Bonds are underweight because they were 30% actual versus 40% target. And cash is actually right on target. We wanted 10% actual, we got 10% target. Next, you need to know what to actually do with this information. And this is where the strategy really, really matters.
First up, determine your target asset allocation. This is your ideal mix of investments, and it depends on things like 1. Your age, 2. Your risk tolerance, 3. Your financial goals.
With regards to age, generally younger folks, they can afford to be more aggressive with more stocks in their portfolio. And for risk tolerance, this really depends on your personality type and your situation. Now, I did make another video that really dives deep into risk tolerance that'll help you determine your own. That'll be really helpful if you aren't sure what it is. So stay tuned as I'll link to that a little bit later in this video here. And finally, when you look at your financial goals, consider both long and short-term goals to see how your investing strategy can get you there faster.
Next, let's focus on when and how much you should be rebalancing.
All right, so you've got two main options here. First is calendar-based rebalancing. So this is like getting an oil change every 3,000 miles. You rebalance on a set schedule. So maybe it's once a year, every quarter, whatever you're comfortable with. Next is threshold-based rebalancing. So this is like waiting for your hair to reach a certain length and then going and getting a haircut, right? You set a threshold, say 5%, and rebalance when any asset class drifts beyond 5%. So for me personally, this is what I prefer to do is I check my portfolio almost daily. But if that's not you, that's fine. Focus on calendar-based rebalancing instead. Also, pro tip here, you can always use a combo approach, right? So if you're one of those folks that, you check your portfolio annually. But what you want to do, that's fine, but you want to keep an eye out for any big market swings that might throw things out of whack. Remember, the goal isn't to hit your target allocation perfectly every day. It's really about keeping things in a reasonable range to manage the risk and stay on track for your goals. Now, here's where things get really interesting. So in our next section, we're going to reveal the secret sauce, so to speak, of rebalancing. So these are the actual strategies that pros use to get their portfolios in tip-top shape. And trust me, you really don't want to miss this part because I'll be sharing kind of a mind-blowing strategy that could potentially save you thousands in unnecessary taxes.
Next, let's walk through the actual process of rebalancing your portfolio. Don't worry, it's not rocket science. but it does take some concentration to make sure you do it right.
So step one is selling overweight assets. So remember earlier how, we were talking about identifying which investments were taking up way too much space in your portfolio? Well, it's time to trim those down. So as an example, let's say that stocks, they've grown to 70 or 80% of your portfolio. You'll need to sell some of those stocks to get back to your target. But here's something to realize. When selling, consider using the specific identification method. So this lets you choose which shares to sell, potentially minimizing your tax hit. But I'll cover more on that whole process in a minute, so let's not, spend all of our time on it here now. Step two is buying underweight assets. Now that you've got some cash from selling your overweight assets, which we just talked about a second ago, it's time to beef up those underperformers. So in our example, where bonds, they're at 30% of your portfolio versus the 40% you'd want, you'd use that money to buy more bonds, bringing them back up to their target percentage. But also, you want to keep in mind that if you've got new money to invest coming every month or however often that is, consider using that to buy more of your underweight classes. This way, you can rebalance without selling anything and potentially triggering taxes. Step three, and this is a big one.
That's what she said to me, 6 years old.
Considering tax implications. So here's where things get really interesting, right? So remember that tax saving hack that I had just mentioned, the specific identification? Well, when you're selling assets, you've got to think about the tax man and spend a lot of time doing that. Because selling investments that have gained value, they can trigger long or short-term capital gains taxes. But here's the kicker. If you're strategic about which specific shares you sell, you can minimize your tax bill. For instance, if you bought shares of NVIDIA in 2020 and 2023, and some just a few months ago, when you place a sell order, your broker, they may choose random bundles of stock to sell. Now this matters because the shares that you bought a few months ago, if you sell them now, you'll get hit with a short-term capital gains tax versus long-term. And you may not get as much cash out of that stock as you wanted. And one other thing to remember, if you've got some losers in your portfolio, consider using what they call tax loss harvesting. This basically means selling investments at a loss to offset your gains elsewhere. So while it does suck to lose money on an investment, it happens. But keep in mind that the positive here is that you can offset your gains with those losses to pay less in taxes. Now, I know what you're thinking, it sounds really complicated. I get it, but really don't sweat it. Start simple, and as you get more comfortable, you can add in these more advanced strategies. So in our next section, well, trust me, you really won't want to miss this because it could save you from some serious financial headaches down the road.
Now that you're practically a rebalancing pro, let's talk about some common mistakes to avoid. These are very easy to make if you aren't paying close attention while rebalancing and can make a big impact.
First up, emotional decision making. So we've all been there, right? The market takes a nosedive and suddenly you're thinking about selling everything and just stuffing your cash under a mattress. But here's the thing. Rebalancing is all about sticking to your plan, not reacting to every market hiccup. So as an example, let's say that stocks have a really rough year and they drop by 20%. Your gut might be screaming, sell, sell, sell. But if you've set up a solid rebalancing strategy, you might actually need to buy more stocks to get back to your target allocation. Now I know it sounds crazy, but buying low is how you will set yourself up for future gains. So when you feel that, panic rising, take a deep breath and remind yourself of your long-term goals. Take 24 hours before you even log into your brokerage account so you have time to really think about your plan before you take any action. And now let's talk about the biggest mistake that I mentioned earlier in the intro, and that is ignoring costs and taxes. So when you're rebalancing, it's not just about hitting your target percentages. You really got to think about the cost of getting there. So here's the deal, okay? Every time that you buy or sell, you might be racking up trading fees and accumulating capital gains taxes owed on top of that. But don't worry, I've got some tricks that can really help you avoid this. So what you want to do is you want to use new contributions to rebalance whenever possible. So if your stocks are underweight, use your next investment to buy more stocks instead of selling bonds. Next, you want to rebalance in tax advantage retirement accounts first. So in other words, There are no taxes on trades in your 401k or your IRA, so keep most of your funds here if possible. And this is a really big advantage to retirement accounts, right? When you're not dealing with taxes, rebalancing, it's a no-brainer. You just can rebalance every day if you want, and you don't have to worry about taxes. It's a beautiful thing, so just take advantage of that. So when you do need to sell in taxable accounts, be strategic, right? Use the specific identification method that I mentioned earlier to choose the actual shares to sell. And you might pick shares with the smallest gains or even losses to minimize your tax hit. You also want to consider tax loss harvesting. So we've covered it earlier, but sell your losers. It'll make it so that you owe less in taxes, and it just basically gets them off your portfolio, which feels good too. And don't over rebalance. So small imbalances, they aren't really worth the cost of fixing. So a good rule of thumb is to only rebalance when an asset class is off by 5% or more. And remember, the goal isn't perfection, it's progress. A slightly imbalanced portfolio that saves on taxes and fees, it's likely gonna perform better than a perfectly balanced one that's, bleeding transaction fees and taxes in every single trade. And hey, if you found this video helpful, I've got another one about understanding your risk tolerance that I mentioned earlier that I really think that you'd like. And you can check that out by clicking right up here. Or if you're in the mood for something different, YouTube is gonna give you a recommendation right here. I don't even know what it is, but I hope you love it. Now wait, before you head out, don't forget to hit that subscribe button to unlock financial success one AI chat at a time. Thanks so much for watching.